We're pleased to be joined on Trading Nation once again by Ed Yardeni, president of Yardeni Research. A lot of big picture, longer term stuff to talk to, Ed, but I want to address the last couple of days if we can. Obviously, Monday and Tuesday, we saw some down days for the market, stuff we hadn't seen in a while. Wednesday, we had a nice run up, then quite the reversal. Does that signal anything to you necessarily about the market, this kind of a fairly steep intraday reversal?
Well, I hope it's signaling that we're going to take a little break here, take a little rest. This bull's got to be pretty exhausted after the kind of run we've had over the past year. And there's actually, I'm running into a lot of people that have been kind of hoping there'd be a correction so they could get back in. I don't know if this is it, but the fact of the matter is if there are, in fact, a lot of people waiting for the market to come down to buy it, maybe there isn't really that much downside because they'll be coming back.
You think it'll go down more?
I don't think so. The only reason it might go down some more is just because a lot of people did get in kind of late here over the past, let's say, few months, and it may not take much to scare them out of the market, make them think that maybe they got in at the top. But I don't think this is the top. The top will be made when it's pretty clear we're falling into a recession, and we're nowhere close to that.
So much good stuff is happening right now economically. Yep. The economy's strong. Unemployment is down. You've got, obviously, earnings are up. We're starting to see some wage inflation, some labor inflation. These are all good things. Earnings have been solid. However, Ed, I do wonder if these rapidly rising yields, still low historically, I admit, but rapidly rising yields might sort of be, the arrow that shoots at the heart of the market. What do you think?
It could be. I mean, if we're going to have a free fall in the market, it's more likely to be something like 1987, where there was no recession, but the market, even back then in 87, rallied partly because at the end of 86, there was tax reform, wouldn't you know it? And it wasn't until October that the market really took a dive for all sorts of reasons, but one of them was bond yields, in fact, went up quite a bit. They went up by like 300 basis points back then. Here, there's talk that if we just go over 3% on the 10-year, that might unnerve the market. I don't think so. I think seeing the bond yield go up here would just confirm that the economy is doing well, that we're finally seeing self-sustaining growth, that the Fed can raise interest rates some more, and that's actually a healthy thing. But, it's easy for me to say that. Investors who've been getting in of late may get very nervous that they got in too late, and that could put some more downward pressure on the market.
Is tax reform going to give us another leg higher? Would that be sort of the cherry on top, if you will, Ed?
Well, the tax reform is just having an extraordinary impact on earnings. Analysts, since the tax package was enacted, have raised their earnings by $7 a share for this year. That's a big increase. That's from what might have been $146 this year. Now they're looking for $7 more than that. So that's just the initial reaction. We'll see what else is to come. And by the way, that's not the only positive. The other positive is all this repatriated money that's coming back. We've been reading some of these conference calls the companies had, and it almost feels like they want to pinch themselves. They can't believe, how great this is for their business, and they're just trying to figure out all the ways they can spend it.
Yeah, I mean, that's it. I guess here's a stat I read today. I put out, and it came courtesy of the Stock Traders Almanac, which is based on history, and it's fun to read and whatever. I don't take it as gospel, but I find it interesting, is that since 1950, every time the market has gone up 4% in January, I mean, literally 100% of the time, the S&P has ended the year not only higher, but with an average gain of 22%. In other words, this kind of January means really good things for the full year. Do you buy into that this year?
Well, I buy just because we started out with just such a fundamental tailwind, really, and that's the tax reform. I mean, I think it really is a big deal, and in some ways could turn out to be momentous for earnings. I'm not a supply sider. I just tend to kind of stick with the facts rather than get into preachy kind of stuff. But I'm inclined to believe that the supply siders could be onto something, that with companies getting all this money, and this money is showing up as one-time bonuses for workers, it's showing up as wage increases. They're saying some of them are that they're going to spend it on plant and equipment. I mean, it's kind of like Santa Claus is still here.
Yeah, well, Santa Claus is still here. We'll see if the last couple of days changes that. But so far, January was a pretty doggone good month. Ed Yardeni, you're a pretty doggone good guy, and we appreciate you coming on Trading Nation. Thank you.
Thanks, Mark. Thank you.
Ed Yardeni of Yardeni Research.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.